Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Really happy that you're here. We put this show on to try to help you with your retirement. We cover retirement planning, we cover asset management, and tax planning are the main categories. And so you can throw your questions to us even now. You can send them through the email at asktomtalkmoneywithtom.com, or you can sign in and do it through chat on the channel here. So that's how we do it. We often include questions that came up during some of our client strategy sessions also. And so we believe that the more you know, the better you can do. Even if you have an advisor like us, you can go to our channel, you can subscribe to the channel, look at some of the different videos we have there, obviously, and hit the little bell button if you want to get notified when new stuff comes out. Of course, you can always just meet with us. If you have some questions that you want to ask us directly, you can book an appointment, 30 minutes with Ethan and I. There's a button on our website, looks just like that, and you can go to the website to the link here on the channel. So I look forward to being able to do today's show. This has been a really fun, journey for us as far as that goes, and I'm glad that you guys are enjoying it. I want to start off, as I do each week, kind of with a summary of what I saw happening with the market. As you know, I put out a video, Monday through Thursday, just about the market and what's going on. And then on Fridays, I try to do a summary. And so this is the market, going back to the 2018 timeframe, and we can see, kind of what's been going on. This week, market looks like it might be down a little bit in the end.
A little bit.
And really, if you look at the overall trend, though, it's very strong, really good markets altogether. We're coming off an all-time high from last week, and October can be kind of a rocky time frame. We're heading into election. And again, I've mentioned before, election, presidential election years, we generally have some softness in that 60 days prior. My personal opinion is people want to see what the results are going to be, if they're going to make bets one way or another, depending on, what the makeup is, the White House and Congress, as to what direction you might want to go. And so tends to be very good after the election. So we'll see what happens this time. It's one of those things that so many people are talking about. Sometimes you wonder if that's going to be true, get so many people on one side. Nonetheless, the fundamentals are there. The market is still doing pretty well. Earnings are, continuing to come through. And then today, of course, we got a big surprising jobs report. This is a big report right now because the mandate for the Federal Reserve is a dual mandate. Full employment, which is around 4%. Unemployment today dropped from 4.2 to 4.1. That's within their range of what they're looking at in terms of full employment. And then the number of jobs created, I think it was about 170,000 was expected, and 245,000 is what we ended up with.
Yeah, it was a really big surprise to the upside, and they revised the previous months up too.
Yeah, that's kind of interesting because that's been kind of controversial. Earlier in the summer they revised, which is what these things are constantly being revised, and they revised down a lot of the months from earlier this year. Today they revised up a couple of the months, and then of course today's jobs report was quite good. And the last couple of months we've had a couple of big drop-offs after the jobs report.
Yeah,
also
the first week of the last 2 months have been kind of weak following the job report.
Yeah, and so again, if you just look at the basics, if you look at the gross domestic product, if you look at earnings, they're doing well. And so you can't have a terrible job market and have those types of scenarios. You got consumer spending is going okay, and so whether they tell us the right numbers at the right times or whatever, you can see in other ways kind of what's going on and how the markets are working as far as that goes. And so I want to switch to talking about a little something different here. Can we move the Chiron out of there? I'm going to push this and watch this. So here we go, putting a little, whoops. Oh, it's not working again.
Is it on?
Let's see. Yep, it won't change the slides.
Okay.
Thank you. So what I was trying to do is put that little arrow in there. And so that arrow represents the first video that I did. Okay, March 22nd, 2020. I sat down and did a video with the express purpose of trying to point out what was positive. Because here's the thing, at that time, the market's dropping faster than it's ever fallen before. We hit the fastest 35% drop in history. And so I have clients that are obviously worried about their financial, but they're also worried about health. We had this dual kind of physical and financial fear going on. And I was just trying to point out, what was positive at that time. And that's been the main concept of this whole show, of the videos that I do every day. And the reason is because you hardly ever see the positive news. Mm-hmm. It gets buried in the negative. And I don't want everybody, including myself, to be looking through everything with rose-colored glasses, because you can get burned that way too. You have to have some balance. And what I was sensing, especially then and even today, is the balance is still on the negative. People still feel that, oh, this is going to happen or that's going to happen. They're always waiting for the other shoe to drop. And in the end, if you look at where that arrow is and you look at what would have been the better thing to focus on, positive or negative, all right, the market is up almost 150% from where that arrow is at the bottom there. So it obviously would have been better to focus on the positive, and rose-colored glasses would have paid off quite well in this particular scenario. However, again, I'm going to present something today that came up this week that I thought was pretty interesting. And I bet a lot of people didn't hear about it or see it. And again, it's because, we're worried about the Middle East, or we're worried about the election, or worried about all these things. And a lot of them can be kind of negative, and it kind of crowds out that positive. And so that's what we're here for. And so UBS, all right, so UBS is one of the largest wealth management firms in the world. They have $3.1 trillion under management. Guess who's the largest?
Is it BlackRock?
Nope, not for a wealth advisor firm. Yeah, BlackRock is the largest, asset management firm. Charles Schwab, 9.1 trillion. Nonetheless, UBS had a report today, this week, coming out saying, is the U.S. economy set for another roaring 20s? Okay, so here we are in the 20s. Can we have another roaring 20s? Now, what's interesting about this is one of the things about halfway through 2020, when the market started to really come back, and all the way through 2021, I kept talking about the last time we had a pandemic, it was followed by a very strong stock market. It just took a while for it to really take off and for everything to come into play. And we ended up with this big run up. And so I just think it was kind of interesting to see what's going on. And so here's the criteria that they have for officially declaring the 2020s a roaring 20s. Gross domestic product of 2.5% or higher. Check. All right, We're at 3% gross domestic product for annualized for the last quarter. Good. Inflation of 2 to 3% range. Check. Right, we're there at this point in time. Fed funds rate around 3.5%. Not quite. We're at 4.75 to 5. Right. So we got a ways to go, but we are hopefully still trending downward. We might be able to get to that. 10-year Treasury yield around 4%. Well, with today's big jobs report, actually, the Treasury yield jumped up to almost 4%.
Yeah,
so
close.
It's another check. So we're really close. As a matter of fact, one of them we're on the way, most likely. Now, one of the things that they're talking about here is that they say this is their best case scenario. A lot of these companies present, here's our bull case, here's our bear case, here's our neutral case, those type of things. But they did say that this is the one that they have at a 50% likelihood of happening. Mm-hmm. Which I thought was quite interesting. And so, they've got they said that there needs to be some push and some what they call megatrends. So they've identified these 4 megatrends. A capital spending boom could occur, right? Mm-hmm. So what's happening with labor costs growing, you're getting a lot more automation, you're getting, a lot of money being spent on that. The infrastructure in the capital is it's aging, and so, replacing that. And then enormous investment required to transition to green energy, right? So as that continues, we're seeing, that be a possible mega trend. Focus on security and deglobalization. I actually find this one to be the most interesting because what happened during the pandemic, we realized, we need to be able to make some stuff, onshore. They call onshoring, right? So, now we got these big bills that are coming out to try to deal with semiconductor, which is a big one, here in the U.S., and they're going to continue to do that. That's a massive spend that's going to happen to kind of do that. Of course, and they call it, friendly countries that you might, still work with, and all these different things. It's very interesting to see
Yeah,
how
there's
that's
a shift
playing
to
out.
more being on the same continent.
Yes.
Even if it's not your same country, you could be like for
Yep.
U.S. Manufacturing in Canada or Mexico
Right.
instead.
Exactly. Exactly. And so that takes money. That money comes in. It gets spent. It stimulates the economy. It creates, a good stock market. So then, of course, investments in artificial intelligence are expected to rise. So those are the four big mega trends that they're looking at that could propel us into that kind of roaring 20s concept. Okay. And so I just think it's very fascinating. Again, keeping our eyes, on, some positive news. I would again bet that not a lot of people saw this report. It came out in Forbes, so they wrote about it. It again gets buried in all of these other things that have been going on at this point in time. But I think it's very important to look at this because yes, we're up 150% since kind of started these videos by chance, but who says we can't be up another 150%? So just having that balance, having that positive thought process to go along with all the negative things, because all the time clients are sending me emails that they're getting that everything's going to collapse, and all the time, all the way through that 150% raise. I've had clients sending me negative emails. And why do they send those negative emails? Because people respond to fear more than they do to other things like greed.
Yeah,
or
fear is the number one
Yeah.
emotional response.
It's why the stock markets go up slowly and down quickly. It's the fear is much stronger. Okay, so here's a very long-term chart going back to 1881. This is a combination of the Dow and the S&P, and this is TradingView. They make this one chart. I think it's kind of interesting. Where I have that arrow, that's the roaring 20s, right? So you could say the bottom was about 1921, and of course the end of it was 1929. So it was like an 8-year run altogether. Unbelievable run. I mean, straight up. As a matter of fact, it's probably on an 8-year basis. I'd challenge somebody to find a better 8 years. The best 5 years, we can see just above me here, was the 95 to 2000 run that happened for the .com. But in terms of an 8-year run, that's a big one. Of course, it was followed by that big downturn. And so let's just talk about that for a minute. Again, kind of balancing out our thought process. Number one, we might be, if this comes out to be somewhat accurate, in the run of this, not at the end of it, but there will be an end to it at some point. And oftentimes these things create these bubbles that then pop, right? And back in the Great Depression and the Roaring 20 timeframes, a lot of people were using margin to buy stocks. It was very common, and the margin requirement was only 10%. So you could buy $100,000 worth of stocks for $10,000, right? So I don't have a single client that uses margin. I think one thing we've learned about margin is that it's
dangerous.
It's dangerous. It's not for the everyday thing. As a matter of fact, the Dow Jones was a lot more like Bitcoin at the time, in terms of its volatility.
Yeah, it was Wild West kind of.
Yeah,
It was
yeah.
in infancy. But now you can kind of see it's moved to options. There's a little bit more.
That's right, and that's where you're getting some of the leveraging concepts and what have you. So it's still out there, and people do it. It's just not my clients. But what happens at kind of the dichotomy of these bubbles is similar. You start to see, like, for example, next year we should start to see an IPO market form. It should start to have more IPOs. Eventually the IPO market will get crazier and crazier, like it did in the .com bubble, where we had things that came out without earnings and such. Because right now, there's a lot of artificial intelligence companies that could come public, but there's a lot of money in that space already, private money, so they don't really have to go public. And they don't all have earnings yet, that kind of thing. At some point in time, as the things develop, that dichotomy, they won't have to have earnings to go public. That's what happened in the .com. So those are things we kind of watch for. What kind of craziness is going on? Even in the 2021 run-up, we ended up with those SPACs, right, which I thought were really nuts and turned out to not work out very well. So those are some of the clues that we'll be watching for throughout this run. We're not there yet. We're not seeing that. We don't even have an IPO market of any substance, at this point in time. I do think, and I've been saying this for a little while, I think 2025 is the year that the IPO market could kind of start to go. And there's got to be a whole bunch of IPOs sitting out there waiting to go, just because there hasn't been many done for a while. So the other part is you should have some type of a process in place so that you're not going to ride through the end of that bubble, which in this case was an 87% stock market drop during that Great Depression. So some rotational concept where you can stay in for as much as you can, like, last year's 10% drop, you can stay in for that. But when it starts to get worse and worse, you have some capability of being able to get a bit more conservative and kind of wait, preserve some capital and wait and then come through. So anyway, I don't disagree with what they're talking about in this article. Matter of fact, it's something I talked about, in prior years, and I just want to, continue to focus on, what some of the possibilities are here, because things are much better than people seem to know. I mean, if you interview the average person, they think the economy's, not doing well. It's actually doing very well, and so, that's partly what's happening now. This is last week's bet on what was going to happen with the Fed funds rate at the November 7th meeting. It was actually 57% said a half a point rate cut.
Yep.
Right? Now, okay, after 1 week, we're now at a 97% chance of a quarter
cut.
Right, rate cut, and 3% chance of no rate cut. And that's because the reports that have come out have shown a lot of strength. So especially this jobs report today, because just in 1 day it went from 32% chance of a 50% drop to zero based on this one report. So not all that important. It's just kind of interesting. It just shows that we have a chance for this soft landing or no landing scenario where we keep going along, even though they raised rates so much that it should have caused a recession.
Yeah, so you have a slowdown, but you just don't have actual negative growth.
Yeah, exactly. And who knows where we might end up with all of that. But I will say, again, the key thing that happened, the reason that Wall Street was so dead wrong last year was unbelievable how many articles and major players in major places talking about huge drops, 20% more or drops in the stock market in 2023, because when you raise rates 5.25% really quickly, like the Fed did, you get a recession. I agree. However, not during a pandemic, because what happened for the pandemic was so much money was pushed out the door, and then you ended up with kind of a trapped population that then got freed, and they're out spending money and traveling. And I do think that stuff is normalizing out now, the travel, just talking to clients and reading articles and looking at things. And I think the pent up demand portion is kind of settling down, but we have these other 4 mega trends coming in with capital expenditures, the green energy, the deglobalization, that's still going, right? I mean, that's going to take a long time. It'll go for 20 years based off of this pandemic that just happened. And et cetera. So that and artificial intelligence is just really icing on the cake. It's not the only thing out there that's pushing all of this. And so I don't know. I think that, again, focusing on, what's going on that is positive has some benefits to making us all, more balanced investors. It's really easy to fill out the negative side of a chart, so to speak. It's a lot more difficult to find all the positives to put down on that side to get that balance. So, that's what we'll continue to try to provide with these. So I want to thank everybody very much for, listening to our summary this week. And, again, we'll look at doing this again next week. So. All right. So what questions do we have?
So what would it mean for the market if the Federal Reserve held rates at what they are for next meeting?
Okay. So as of right now, the futures market has a 3% chance that they hold rates and a 97% chance that they lower rates by 1/4 point, right? But the trend is moving towards less cuts or no cut, right? Definitely over the last couple of weeks as these reports come out. The thing that's interesting is Chairman Powell just last week was speaking at a conference and Q&A, and he, in my opinion, insinuating that they might not do a rate cut. That was my read of it anyway.
Yeah, I think they'd rather go on a conservative approach with the cuts.
Well, they just got unemployment back down to kind of where they want it. They're getting some, they're looking at, the economy. And I think personally, they're willing to have a slightly higher inflation rate, and not just 2, but like 2 to 3%, which I think is a much smarter goal anyway.
Yeah, having a good range is easier.
Yeah. Anyway, but that's, or letting it come down slower to that 2%. Which would make you think they're going to do a cut. But the market is factoring in one rate cut right now. if you have no rate cut in November, the market is going to adjust downward based on that, because that's sort of a stimulus that comes into the economy when you lower those interest rates, and that stimulus wouldn't be there at least in November 7th. However, if they're not lowering rates, there's a chance that they're doing that because things are good. And ultimately, if things are good, earnings are good, and that's what drives the market. You can talk about anything you want. You can talk about all of these different issues that happen. How does it impact earnings, right? I mean, the Middle East tensions, for example, are happening right now. You look at that, and the market's still doing okay, even though it's kind of a scary situation. It's a very negative situation. However, the main thing is oil. Right, and so oil has gone up in price, but it's still at $75 or whatever. That's not enough of a high price to create real problems for the economy. So, again, I think that that does factor into a no rate cut, though, right? If oil prices continue to go up between now and November 7th because the Middle East tensions continue to go, that's an inflationary force, right? And so, if you want to slow things down, you'd leave rates up. And so, we'll see. So it depends on why they're doing it in the end as to how the market will react. Are they doing it because inflationary forces are coming up, which we're not really seeing yet, but could be by November 7th? Or are they doing it just because their employment numbers are good, which is the other part of their mandate, and that they're really focusing on jobs and labor market instead of inflation, and they're just going to sit on their hands because they don't have to do anything in theory, right? I mean, the problem that they're having, and they will have, and everybody would have, and every Federal Reserve ever has, is that the impact of those cuts and or increases are pretty far off, right? And so it's a really hard guessing game. I would bet that they'll continue just to do a quarter point at a time, a little bit at a time, and see how things go as far as that goes. If we get a big pop in inflation, I did look up the inflation projections for the next 2 months. The Cleveland Fed, I think, puts out the inflation projections, and it's exactly the same actually for core PCE. It's 2.6 something, or right in that range. So pretty much where we have been for the last 3 months. And so they're expecting that to continue. So not coming down, not going up. We'll see how that plays out.
And the nice thing is also wages are going up still, and so that wages are outpacing inflation. So people over time are feeling less of the bite of inflation.
Yeah, via survey, people are starting to feel more and more positive about the economy, their spending power, and those types of things. And I think that's what's happening. Yes, the costs have gone up a lot, but people are actually making more too. So it's all about what you can afford, and this is across the big group, all of us. Any one of us individually can be in a really good or really bad situation. But across the board, we are seeing wages grow faster than inflation. All right, what's our next question?
Can there be a step down in basis for inherited assets?
A step down. So let's talk about the step up first, because that's what most people are familiar with. So
that's
step
what
up.
we always refer to.
Yeah, I buy something for $10,000. It's worth $100,000. I pass away. My beneficiaries get that. If I would have sold it, I would have had a $90,000 gain. They get a stepped up basis to current value. Theoretically, they sell it on that same day, or sell it at that same price. They would have a step up to $100,000 cost basis, which means no tax.
So essentially, what happens with inherited assets is the basis moves to the market value when the person passes a day of death, essentially.
Right.
And so, let's say you have an asset that you bought for $100,000, but the market value is only $40,000.
Yep.
Unfortunately, the basis will go to the market value of that $40,000 on the day of the death, rather than keeping that 100,000. So you can't really pick and choose if it's beneficial or not to change the basis. You only get that day of death, essentially.
Yeah, so it's going to change either way.
Yeah.
And so you basically would have lost that ability to write off that $60,000 loss that you had.
And so most of the time we never run into this, because a lot of times that when we keep assets for a long time is because there's a taxable implication if we sell them.
Right.
But let's say you have company stock, you love that company, but after you retire, the company hasn't done so well, but you don't really need the money, so you just keep it for sentimental value. What you could do with it is you could, if you know that you're kind of nearing the end of your life, or you foresee that, you could then gift it to whoever you want to inherit it. So if you gift it to somebody, they maintain that basis. And so if you go above the gift tax, I think it's 18,000 for 2024, you would go into your lifetime exemption, which is kind of the same as your estate tax. They kind of have this same kind of benefit together number that they use.
Yeah, I'm a big proponent of trying to harvest losses pretty much on a regular basis. If you love the stock, still think it could do really well, and you got a big loss in it for some reason, maybe you worked there a long time ago, you could sell it and buy it back in 31 days and capture that loss and still have the stock. Right now, you might have the stock move dramatically in that 31-day period. That's the risk. But if I put 100,000 into something that's now worth 40,000, I could capture that $60,000 loss and buy back the stock and be in the same spot. I still got $40,000 worth of stock, but now I get to write off this,
Loss.
$60,000 loss off of my tax return year after year until I use it up. I can write that off of gains. So it allows me to get $60,000 worth of gains someplace else, or even in this stock if it happens to come back.
Yeah.
To be able to use that. It doesn't have to be a planning process in terms of, hey, end of life type of thing. You just do it regularly. Capture losses, capture losses, capture losses. We do it all the time. And because not every investment we make or anybody makes money all the time. But you're right. The ones that do are the ones that we keep. Like, for example, we still have, in March 5th, 2020, the market was dropping so fast. We didn't have a chance to really, do anything defensive. So we started taking a look at what was holding up the best. And Apple and Microsoft were holding up well, mainly because they're kind of like safe plays, right? They make so much money, they have so much money, and they have such good name recognition. And so we have clients that still have, those shares because we bought them in, taxable accounts. Happily, actually, has still done well and still continue to do well for the most part. But those ones that are at a loss,
yeah, it doesn't have to be stock. It could be other assets that maybe are a little bit more illiquid too. So, and maybe it's harder to sell, but you want to make sure that if it does sell for below market value or below what your cost basis is, you could gift it to them. So it could be some sort of collectibles and stuff like that if you have records of that.
Yeah, I do have one client that has a fair size net worth and what have you, and it's actually gifting appreciated stock. Because his tax return, his tax rate is higher than the people he's giving the money to. And so they can sell it and pay the tax, and he just gives them enough so that they're, able to pay the tax too with the differential. And, so you can go either way with that. But yeah, it's not a bad idea. If you have a negative and you're going to, gift, they get to keep that negative. They could take that right off, so that's good. Yeah, it's a good question. It's really interesting. It does go both ways. You can you basically mark it to the date of death on all assets, whether it's a gain, or a loss.
So I have extra money building up in my emergency fund. It's an HSA account, a high yield savings account, and just with the interest, it's built up more than I actually need for 6 months. What should I do with the extra funds?
All right, so we have an emergency fund. We're targeting 6 months, which is a personal decision, right? And so we've got that. Now we've got more, because these high yield savings accounts are paying 4% or something, right? And yeah, that's a good question, actually. And that goes for almost anything. People ask me all the time, well, how much should I keep in savings, for that? And it could be anything. And it's always the same. You pick a dollar amount, in this case, 6 months worth, okay, whatever it might be. If that makes you happy, then the rest should be somewhere else. Because, even at 4%, you're not making long-term returns that you would make in the stock market. Maybe you at least to do something like a CD. If rates are coming down, your high yield savings account's going to come down to 3% or something. Maybe you lock in something a little longer on a CD with some of that excess money. Right? There's lots of different things you can do with it.
You could also, say you want to spend a little portion of it on yourself. You have to always remember to balance your future with your present self. And so maybe you take a portion and say, hey, I've been eyeing these headphones for a while and I just want to buy them.
Yeah.
So that would be a good idea.
Yeah. Yeah, exactly.
And another thing is, if you have any kind of long-term expenses that you're kind of thinking about, let's say you have a water heater that needs to be replaced, you had it looked at and he says you're going to replace it in maybe 2 to 3 years, maybe you start adding the extra additional money to your emergency fund to have the cash on hand.
Yeah, it's sort of a different look at it. Emergency is emergency, but you also have these known things that are going to happen. I need to paint my house X number of years. I need to get a car every X number of years. I need to likely replace, pieces of my house as they disintegrate over a period of time. And so maybe you have your 6 months worth of emergency funds, and then that excess money is actually going towards those other known big expenses so that you have cash on hand to pay for that when it happens, instead of having to go borrow the money or eat into your emergency account.
Yeah, and you don't have to liquidate stocks because
Right.
you don't have to risk, where the market is at that point.
Yeah, no, I have a lot of clients that do that. They save for targeted purchases that they know they're going to have to do, and so it's
Yeah, you
not
can
a
just
bad
use the same
strategy.
emergency fund for that too,
Yep.
which is nice.
Yep.
Is it worthwhile to upgrade the house before selling?
Yeah, it's a really interesting question, actually, because that's the common thought would be yes.
Mhm.
Yeah. So I'm going to go out and spend whatever, 10, 50, 100,000, whatever it might be, depending on where I live and what kind of house I have, to kind of fix up the house and make it more sellable. I'd say on the extremes, okay? So, for example, in a market that is really hot, right? I remember I was talking to one realtor once, and she said she listed a house, here locally. They had 38 bids within the first hour, right? I don't think, spending $50,000 on remodeling that thing, you just need one bid that's at your price. And I'm sure
Yeah.
they went way over. Actually, they did go way over according to the realtor. So when you look at that and you say, okay, it should probably be at least minimal as far as what you would do to kind of fix it up, because the market's just so hot. On the other side is a market that's really dead, right? And there's just not much appreciation. And your house, you could very easily spend 50 and get back 5 or 0, because the market's just flat. It just doesn't move, and it doesn't really matter. Oftentimes you'll see in that kind of market, there's just an awful lot of new homes being built. I see that market like flat areas where, here we have all the mountains that kind of restrict the open land,
with the
right?
bays, there's only limited land.
Yeah, and so you get to some place where there's a flat area and they keep building new housing divisions, and you've got your old house, and yeah, you could fix up your old house, but it's still not as nice as that new one that's also on the golf course or what have you. So you got to watch out for the market that you're in and kind of understanding that as far as that goes. And of course, there's a whole science behind, what you would do,
Yeah,
right,
and so
to increase value. What would you spend the money on?
if you're in this position, I would always, contact your local realtor, ask your friends if they have any recommendations, or we could provide, advisors. We've, worked with realtors, that we could, recommend. But you'd always just ask those questions, because the realtor, wants to maximize the price they can sell for, but they also know that you're in it to make the most amount of money for what you put in.
Yeah, exactly. So it's a really good question. It's not an easy answer. Again, it kind of depends on what you're looking for. I would think if you're in a fairly high-end market, you'd want a fairly high-end house, to kind of maximize your gain out of it. But it just oftentimes, like if I look at the market here, it's also really expensive to redo your home.
Yeah. When a lot of the houses that sell in the local neighborhoods, they're built in the 50s, 60s. A lot of times, even if you upgrade the house, a lot of times the buyers just come in and do an entire reno too.
I talked to a contractor once, and he did I think it was in Menlo Park, all new everything inside this house, and I forgot the dollar amount spent, $500,000. Now, this was a really expensive house, sold in that kind of like $5-6 million range, and they bulldozed it. And he just finished like working on it for, over a year, doing it all nicely, and they bulldozed it down. They just wanted the lot, and they built something else on top of it. So, yeah, which is fine. I mean, he was just bemoaning all the work that he put into that place, watching it, get destroyed. So, but it sold, and probably the landlord, the previous owners were pretty happy with the whole thing. Imagine they made a few dollars on it altogether, but yeah, that's right. Sometimes it's better off having a fixer-upper. Somebody can that's what I was looking for when I was looking for a house. I don't want to pay for somebody else's improvements, especially since they may not be exactly what I want anyway.
Yeah, you can build your own house in
Right.
case.
So then you can come in and do your own work. I was looking for something that was on the other end of the spectrum. I do that with everything. When I'm buying cars for my hobby. I don't want a car that's all fixed up. My whole process is to fix them up. So, it just depends. There are people out there that are looking for those types of scenarios. That, if your house is a little cheaper because of those, it might sell pretty quickly too. And then you don't have to do all the renovations. You don't have to spend all the money. You don't have to take the risk.
Mm-hmm.
So it's an interesting area, definitely. It depends on the house, depends on the area, and depends on, what the market is like at the time you're trying to sell it.
So, is there a way to reduce my income in retirement? I am 75 and I'm getting more money than I need for my expenses.
Okay, so let's say I'm 75 and I've got, make it easy, 75,000 expenses, and I got $150,000 worth of income ending up on my tax return.
Mm-hmm.
Okay, so what you do is let's start with this thing called Rockefeller's rule. This is attributed to John D. Rockefeller. In order to have the most efficient tax situation possible, you want to have as much taxable income on your tax return as you're spending in any one year. Mm-hmm. So if I'm spending 75, I want 75, but I have 150. So what do? Well, divide your income into two different categories: controllable and not controllable.
Yep.
Right? So not controllable, Social Security, can't really control that. It's going to come in no matter what. A pension, right?
Pension or annuity that you've annuitized.
Yeah, something you've annuitized, an annuity or a pension. Rental income is kind of a gray area because it's going to keep coming in as long as you have that rental property. Theoretically, you could get rid of the rental property and get rid of that income. I've never seen anybody do that, so I kind of put that into the uncontrollable category for the most part, just because of capital gains and all the other hassles to deal with that. So then you're ending up with these other income streams that are potentially manageable. I guess we could put required minimum distributions into the uncontrollable, right? So over 73, you got assets in IRAs or 401ks or any of these tax deferred vehicles. You're going to be required to take money out, and that's going to end up on your tax return whether you want it or not. Hopefully you met with somebody like us early in your retirement and you started to do some tax planning around those RMDs and how do we reduce them? Does a Roth conversion make sense? There's a whole bunch of things there because that really will make you violate Rockefeller's rule if you have a lot of money in those retirement plans. So, but now we have dividends, interest, capital gains that we take or don't take. We kind of decide, on when we take those for the most part. Those are all investments that are going to continue to produce those uncontrolled incomes or controllable incomes. Sorry, and so what do you do with those? Well, there aren't a lot of things that you can do, right? But you can buy things, you can shift to things that have more of a capital gains basis.
Yeah, so you can go for more growth versus a dividend. Stocks are more value, like a value-based stock.
Right. So you already have more income than you need. So let's just say that means that you have more assets than you need, at least at the current time. You could shift some of those taxable assets to stock market. Maybe they pay a dividend, but it's a lot smaller than, say, a bond.
Yeah.
One of the strategies is that you can take and buy your bonds inside your tax-deferred vehicles. If you want to have the same overall risk, right, you can shift and say, okay, my taxable accounts are going to be in the stock market that's producing, a little bit of dividend, but I get to control the capital gain, and the capital gain rate at the moment is lower than ordinary income, which is nice. And I can have my bond portion inside the IRAs, which allow me to then, tax defer the higher yield that I'm getting out of that. And so that's a viable strategy. It can be not that easy to do just because shifting stuff around in taxable accounts can create more taxable income.
Yeah. You could also shift to municipal bonds or kind of, tax exempt bonds.
That's
an option too. But you also want to compare the rates and see if, because these have lower rates, are you making the same effective return too? Yeah,
exactly. So you're saving on taxes, but you're actually losing money compared to what you could have gotten even in a taxable account. So you have to do the calculation there to make sure that that works out for you. But so it's tax-free. Tax-free still makes, still counts in some areas, like for Social Security taxation. But in this case, let's just say this guy's so far over the income levels, it's not going to matter.
Yeah.
And so that, strategize around, how do I get rid of some of that income. Annuities are out there. They have a lot of problems with them and what have you. But one thing that's good about an annuity is it doesn't spin off income unless you want it to.
Yeah, so if you have excess assets that are generating income, you can put it into an annuity. So you give up your capital gains, but you have this annuity that you can turn on for future income. But you'll be taxed as ordinary versus capital.
Yeah, that's the big disadvantage. Big disadvantage, so I put my money into stocks instead of, stocks and bonds. I put my bonds inside my IRAs, right? So that's one strategy. So I'm getting capital gains. An annuity completely defers all the income. I don't have to worry about it. Even the dividend from the stock stays inside the annuity. But the annuity has a couple problems. Number one, the costs are generally higher. Although there are some very reasonable no-load annuities out there, it's still a higher cost internally versus what you would be able to do on your own, just buying some stocks and such too. And then secondly, the stock is now going to have a capital gain if you sell it at a gain versus any gain that you take out of that annuity is going to be at an ordinary income tax. Which for a while was the same thing.
Yeah.
They changed that back to being cheaper for capital gain. So, that's a disadvantage as far as that goes.
And then also for your heirs too.
Right.
If you inherit stock in a taxable account, you get that stepped up basis. If you inherit an annuity, the annuity company usually asks you to figure out, a payment option of some
That's
sort.
right. Yeah, and your kids will pay the ordinary income on it. Maybe their tax bracket's lower or something that could help, but I guess one other advantage of an annuity is that, if I go buy these individual stocks or stock ETFs or whatever it is, and I'm trying to lower my taxes that way, I'm not going to be able to change them much. So I better stay very diversified and very broad because I'm not going to be able to change them. Whereas within the annuity, I could change it all I want, because it's free transactions usually inside the annuities. And I could have different strategies. I could get more conservative or more aggressive or however I wanted to do it. So again, there's pros and cons to all of that. It is actually a really big component. If you follow Rockefeller's rule, your money will last longer, in my opinion.
Yeah,
I've
and
done
one
a lot
thing
of
you
plans around
can
that.
do with RMDs too that we didn't talk about is qualified charitable
Yeah.
distributions. And so, if you're making charitable contributions every year, the way you do it is you can do a qualified charitable distribution from your IRA, which would to take as your RMD essentially, and that income never shows up on your tax because it goes directly from your IRA to that charity.
Yeah, so let's say that you give $10,000 a year to charity or some number, and now all of a sudden now you're 73 and you have this required minimum distribution and it's $10,000. So you can actually directly give right out of your IRAs to the charities that you've always been giving to anyway, and now that $10,000 doesn't end up on your tax return.
Yeah, and the nice thing is it's just a direct there, but usually you have to make sure that that charity cashes it before the end of the year. That's the important thing. So we recommend you if you're planning to do it before the end of the year, start to do it in October because, with our custodian, they guarantee that November 15th they'll execute. Anything after that is best efforts. So you want to kind of get this in, I recommend, doing it, October or early November, getting those QCD checks done.
Yeah, because in order to figure out how much, let's say, you've given $10,000 to 10 different charities, 1,000 each, and 2 of them don't cash the checks. Well, if they don't cash the checks, that's not a distribution from your IRA.
Yeah, and so you could be short.
And so then November 15th rolls around and Charles Schwab says, hey, we need to do the RMDs now because we get too many of them at the end of the year. And they haven't cashed those, right? So basically, you got to take $2,000 out yourself at that point in time. So I would start pretty early with all the charitable distributions, if possible, as far as that goes. So anyway, it's an interesting strategy, something to talk about also. So, all right, well, that's today's show. Really appreciate everybody, listening in today. Look forward to next week's show. Send us your questions. Something that comes up, let us have a little time to look at it, come up with some charts or something, some different information. You can send that in at the Ask Tom at talkmoneywithtom.com. And of course, subscribe to the channel. Helps us out here too. You can put in a like or subscribe, hit the bell button, put a comment, whatever you want to do. But we do this for you. This is an educational component of our practice. We really believe that it's important. And then lastly, of course, if you'd like to just meet with us on a one-on-one basis, you can hit the book appointment button. We'd be happy to meet with you. So Thank you very much, and thank you for joining our show today, and we look forward to seeing you again next week.